Imagine, for just a second, the absolute appeal of condo living. I mean, you get the keys, you walk in, and you just kind of exhale, right?
Oh, absolutely. It's the dream for a lot of people.
Right. Because there's no lawn to mow. There are no gutters to clean out on some freezing November morning. You never have to lie awake at night listening to the wind and wondering if the roof is going to hold up through the winter.
Yeah, because there is this very comforting, almost wonderful illusion that the building's management handles all the big, scary financial risks.
Exactly. You just pay your monthly maintenance fees, you swipe your fob, and you live your life. It feels safe. It feels, entirely contained.
It is a very curated type of homeownership. You are essentially buying into a collective, and part of that transaction is purchasing peace of mind, or, well, at the very least, purchasing the perception of it.
A perception.
Yeah.
That is the key word right there. Because today, in this deep dive, we are going to reveal the hidden trap door in that whole turnkey lifestyle.
And it's a significant trapdoor.
It really is. It's one that, if you aren't properly prepared, could literally cost you tens of thousands of dollars in a matter of minutes. So our mission today is to uncover the actual reality of condo insurance, and we have the ultimate smoking gun to do it.
We do. We are working from a stack of highly specific, somewhat intimidating documents for a very real building. So we are looking at a highly detailed 2025 to 2026 Certificate of Insurance for York Region Standard Condominium Corporation number 1268.
Which is located at 7608 Yonge Street in Thornhill, Ontario.
That's the one. And alongside that, we also have a batch of their unaudited financial statements from late 2025 and early 2026.
And if you are listening right now and thinking, why on earth do I care about a certificate and some spreadsheets for a random building in Thornhill? You really need to stay with us, because these documents act as the perfect Rosetta Stone for anyone, anywhere, living in a condo.
They absolutely do. It's the universal language of condo risk.
Okay, let's unpack this. Our core goal today is to translate these incredibly dense, multi-million-dollar corporate insurance documents and the mid-year financials into direct, actionable advice for you, the unit owner. We are going to figure out exactly what personal coverage and policy limits you actually need to avoid falling through that financial trapdoor we just mentioned.
Right. And to understand what insurance you need to carry as an individual, we first have to, establish the baseline. We need to clearly define what the condominium corporation is already paying for on your behalf.
Right, the master policy.
Exactly. When you examine the master policy, which is brokered by Atrons Counsel insurance brokers for this specific property, the sheer scale of the coverage is just staggering.
I mean, when I first flipped to the coverage limits on this certificate, I genuinely thought someone had put the decimal point in the wrong place.
I know, it looks like a typo, but the numbers are entirely real. We are looking at a commercial package policy with over $105.7 million in property coverage.
105 million.
0.7, yeah. That is comprehensive all-risk coverage meant to protect the physical structure of the skyscraper itself. But it doesn't stop there. There is also $35 million in comprehensive general liability. Then another $25 million for directors and officers liability.
Wow.
And finally, a completely separate $105.7 million specifically allocated for equipment breakdown.
Okay, let's break down the mechanics of those numbers, because they are massive. When I first saw $105.7 million for equipment breakdown, my mind immediately went to, the treadmills in the condo gym.
Right, the fitness center.
Yeah, but looking at the sheer scale of this building, we must be talking about the physical life support systems of the skyscraper.
That is exactly what boiler and machinery coverage is for. In a massive residential tower like this one, the HVAC chillers on the roof, the elevator motors, the central boilers, the main electrical panels, these are essentially the heart and lungs of the building.
Right.
If a catastrophic failure occurs in the central heating system during a harsh Canadian winter, you aren't just replacing a heater. You are dealing with astronomical specialized replacement costs, plus the collateral damage of, say, frozen pipes throughout the entire structure.
And with a risk profile that high, I noticed there isn't just one local insurance company writing a single check for $105 million.
No, absolutely not.
The certificate lists a whole syndicate of heavy hitters, right? Like Wawanesa, Intact Specialty Solutions, Aviva, Northbridge, and Travelers Canada.
Yeah.
I assume this is how the insurance market handles something of this magnitude.
Yes, it is a process called risk pooling. The commercial insurance market for high-rise condos has it's hardened significantly in recent years. So a single insurance company does not want to take on the existential threat of a $105 million total loss if the building, burns down.
That makes sense. It's too much risk for one company.
Exactly. So these major insurers pool their capital. One company takes 30% of the risk, another takes 20%, and so on. It ensures that if a catastrophe happens, the payout is distributed and no single insurer goes bankrupt over one claim.
That's fascinating. And speaking of liability, I want to deduce this $25 million directors and officers policy, the D&O coverage.
Right, the D-note.
I'm guessing this exists because condo boards are run by volunteer residents, right?
They are.
And when a volunteer board inevitably makes a controversial decision, like, say, levying a massive fee to replace all the Windows-furious unit owners, might try to sue the board members personally.
That is the exact mechanism at play. D&O insurance protects the personal assets of the board members from lawsuits related to their governance decisions. Without it, honestly, no rational person would ever volunteer to serve on a condo board.
You'd be crazy, too.
Yeah.
So as a unit owner, you see these massive numbers. You see syndicates of major insurers. You see $105.7 million for the building, $35 million for liability, and you think, great, I'm covered. My building is practically an armored fortress.
But
Here is where we need to introduce a crucial analogy. I want you, the listener, to think of the condo corporation's master policy like a giant commercial shipping container.
that's a really good way to look at it. The master policy covers the massive steel box itself. It covers the cargo ship that the box is sitting on. It covers the massive cranes used to move the box. But it covers absolutely nothing that makes the inside of that steel box a home.
That is the perfect way to visualize the boundary. Because there's a letter from Atron's counsel included in these sources, and it's addressed directly to the unit owners, and it is incredibly explicit about this limitation.
It really pulls no punches.
Right. The corporation is responsible for insuring the building and the units only as per the original builder specifications. It also covers the corporation's personal property, common elements like the lobby and gym, and the heavy machinery we just discussed.
The phrasing builder specifications is the red flag every unit owner needs to pay attention to here. The corporate umbrella is massive, yes, but it is incredibly restrictive when it comes to the interior of your specific life.
Let's push on that phrase because builder specs sounds like a legal trap. Like, if the condo policy covers my unit only to the original builder specs, what happens if this building was constructed 20 years ago?
Okay, let's play this out.
Let's say the original developer installed cheap linoleum floors and really basic laminate countertops. But the person who lived there before me did a massive renovation, and now the unit has custom hardwood floors and imported quartz countertops. If the building catches fire, what is that $105 million master policy actually paying to rebuild?
It is paying to install brand new, cheap linoleum and basic laminate.
Wow.
Yeah. The master policy reconstructs the unit exactly as it was handed over by the developer on day one, nothing more. The policy specifically excludes any improvements or betterments made or acquired by any unit owner, past or present.
So the umbrella just stops the second it hits anything nice in your home. Exactly. This transitions us perfectly into Section 2, minding the gap. The Atron's counsel letter draws a bright red line where the corporate shipping container stops and your personal financial responsibility begins. There are three primary pillars of responsibility that rest entirely on your shoulders as a unit owner. Let's start with number one, personal property.
Right, so personal property is the most intuitive one. It basically covers your furniture, your clothing, your electronics, everything you would take with you if you picked the condo up, turned it upside down, and shook it.
Right.
But there is a very specific, crucial detail highlighted in the broker's letter that unit owners consistently overlook. And it explicitly includes personal effects stored in lockers.
Oh, the storage locker. That damp chain link cage down in the third basement level where everyone shoves their winter tires, their vintage vinyl collection, and, like, their grandmother's antique chair.
Yes. Think about the environment of a parking garage. If a main plumbing line bursts down there and floods the locker room with 2 feet of water, the condo's massive property policy will pay to fix the pipe and dry out the concrete.
Right. But it does not care about your grandmother's chair or your vinyl records. That is entirely your personal property, and the loss falls 100% on you. Which brings us to pillar number 2, Improvements and betterments. This is what we were just talking about with the linoleum versus the hardwood floors. Upgraded light fixtures, custom paneling, expensive kitchen renovations.
Yes, all of that.
But here is my question. If I just bought a unit today, how do I even know what the original 20-year-old state of the condo was? I mean, I wasn't there.
What's fascinating here is that the insurance broker explicitly advises unit owners to check a legal document called the Standard Unit Bylaw for their specific building. This isn't just a casual description either. It is a legally binding document registered by the Condo Corporation that defines, literally down to the inch, what constitutes a standard unit for insurance purposes.
So how does a listener actually find this mythical document? Do you just guess and hope for the best?
You never guess with insurance. Never. If you don't know what your standard unit entails, you need to dig out your condominium declaration documents from when you went through closing with your lawyer. Or even simpler, you just email your property manager today and request a copy of the standard unit bylaw.
Just email them.
Yeah, and you want to do this because in some buildings, the legal definition of a standard unit doesn't even include floor coverings.
Wait, really?
Yes, it might define the standard unit as a bare concrete slab. If that is the case, your personal policy is responsible for insuring every single piece of flooring in your home, even if you never renovated it yourself.
That is wild. You could just be sitting on a concrete slab as far as the master policy is concerned.
Exactly.
Okay, so we have personal property and we have improvements. What is the third pillar of personal responsibility?
Personal liability. This is your legal liability for any bodily injury or property damage arising out of your personal activities as a unit owner or from the ownership of your individual unit.
Okay, let's apply our container analogy to this. The building has a $35 million comprehensive general liability policy. So if my guest slips on the icy deck of the cargo ship, say, the visitor parking lot, the corporate policy responds and pays out.
Yes, that's right.
But if my guest walks through my front door, trips over a loose rug inside my steel box and breaks their hip, the corporate policy does nothing. I pay.
That is a flawless application of the concept. The $35 million corporate policy extends to unit owners only with respect to their interests in the common elements. Inside the box, the liability is entirely yours.
Okay, so replacing your custom kitchen after a fire, or getting sued if someone trips in your living room, these are known expenses.
Yeah.
These are the traditional reasons people buy insurance, right?
All right.
Here's where it gets really interesting, because the most imminent financial peril hidden in this certificate isn't just about replacing your own stuff. It's about how the corporation's massive master policy can actually be turned against you.
Yes. We have to examine the deductibles listed on this master certificate because they are the tripwires for the trapdoor you mentioned earlier.
On page 1 of the certificate for YRSCC number 1268, it clearly lists the deductibles that must be paid before those multi-million-dollar coverages kick in. For a standard claim, the deductible is $25,000. Sewer backup, $25,000. Water damage, $25,000. Flood, $25,000.
Those are strictly commercial-level deductibles. A $25,000 threshold is designed to prevent the condo corporation from filing small nuisance claims for every minor leak, which keeps their massive master premium from skyrocketing out of control.
But the Agents Council letter delivers a brutal, actionable warning about this. If damage to the building is the result of an act or omission by you, the unit owner, the corporation has the legal right to charge that entire $25,000 deductible straight back to you.
That's the trapdoor.
Let's paint a picture of how easily this happens.
Yeah.
Let's say you're getting ready for work. You turn on the bathroom sink to wash your face. Your phone rings in the bedroom. You step away, you get absorbed in an email, you rush out the door for work, and you leave the sink running. Simple mistake. An omission.
It happens every single day in high-rises. The sink overflows, ruining your bathroom floor.
Yeah.
But water follows gravity, so it seeps under your baseboards, penetrates the concrete floor, and destroys the drywall, the ceiling, and the custom hardwood of the unit directly below yours. Let's say the total damage to the common elements and the neighboring unit is $40,000.
Okay, so the condo corporation's property policy will step in to repair the structure in the unit below you to those basic standard specs, right?
Right.
But remember, their water damage deductible is $25,000. Because your omission leaving the sink on was the root cause of the damage, the corporation legally hands you a bill for $25,000.
And it is not a negotiation. It is an immediate chargeback. The corporation pays the first $25K out of pocket to the insurer, and they assess that amount directly to your unit's ledger.
This right here is why you cannot just go online and buy the absolute cheapest bare bones renters or condo policy you can find. If you buy a generic policy that only has a, say, $5,000 limit for deductible assessments, and you get hit with a $25,000 chargeback for an overflowing sink, you are personally on the hook for that $20,000 difference.
It can be devastating.
You have to match your personal coverage limits to your specific building's deductibles.
And, it doesn't even require you to physically turn on a tap. It could be the old rubber supply hose on your washing machine that finally bursts while you're on vacation. It could be the aging supply line to your toilet that cracks in the middle of the night. In a high-rise, a small puddle in your unit instantly becomes a waterfall for the people below you.
So a $25,000 chargeback is incredibly painful. But what happens if the building itself gets a massive bill that exceeds its insurance coverage entirely? This is where I want to bring in those unaudited financial statements from late 2025 and early 2026. Because reading a condo's financials is essentially taking the pulse of its vulnerability.
That is an excellent connection. Unaudited financial statements are basically mid-year snapshots. They aren't the final accountant-stamped year-end reviews, but they show you the operating surplus or deficit and, crucially, the balance of the reserve fund.
And the reserve fund is the savings account meant for major predictable repairs, right? Like replacing the roof in 10 years.
Exactly.
Right. But what if something unpredictable happens? Let's say there is a catastrophic structural issue in the underground parking garage that costs $2 million to fix. The insurance company investigates and declares it's a maintenance failure, so they deny the claim entirely.
Which happens.
The building now has a $2 million bill. If I look at these unaudited financials and see that the reserve fund only has $500,000 in it, the corporation is short $1.5 million. They don't just declare bankruptcy, do they?
No, they don't. And this brings us to the second major warning in the broker's letter: insurable loss assessments, which are commonly known as special assessments. When the corporation faces a massive shortfall, whether from an excluded insurance claim, exhausted limits, or a catastrophic repair, they divide that shortfall among the unit owners.
And let me guess, they don't just divide it equally by the number of units.
Rarely. It is almost always divided by your unit's square footage or your proportional share of the building. So if you own a penthouse, your share of that $1.5 million shortfall is going to be significantly higher than the person in the ground floor studio. You could easily receive a special assessment bill for $10,000, $20,000, or even $50,000 payable immediately.
Unbelievable. And just like with the deductible chargebacks, standard off-the-shelf unit policies are completely inadequate for this. A generic policy might cap loss assessment coverage at $2,000 or $3,000, leaving you exposed to absolute financial ruin.
Yeah.
So what is the solution here? Because right now I'm feeling like owning a condo is less about peace of mind and more about navigating a financial minefield covered in cheap linoleum.
Well, the solution pitched in the source document by Atron's counsel is to secure a tailored unit owner policy designed to seamlessly wrap around the specific gaps of the master policy.
Okay.
The broker notes that they developed an exclusive policy called Condo Gold specifically to patch these massive financial holes, the high deductibles and the special assessments for the buildings they insure.
I mean, it is a very efficient business model. They broker the master policy for the building, establish a massive $25,000 deductible, and then turn around and offer a Condo Gold policy to the residents to protect them from the very deductible they just helped create.
Yeah, but the brand name of the policy doesn't really matter. If we connect this to the bigger picture, whether you buy their specific proprietary product or take this information to another broker, the underlying mechanic is identical. Knowledge is entirely useless unless it is applied.
So, listener, here is your actionable advice for today. Your homework. You need to find your building's certificate of insurance. Not next week, today.
Yes, today.
You need to scan the property deductibles and look for the line items labeled water deductible and standard deductible. If that number is $25,000 or higher, which is becoming increasingly common in this hardened insurance market, you need to immediately call your personal insurance provider. You must ensure your deductible chargeback and loss assessment coverage limits exceed those master policy numbers.
You are essentially engineering a bridge over the deliberate gaps left by the corporate policy. The corporation insures the superstructure. You must ensure your upgrades, your liability, and your financial exposure to the corporation's deductibles and reserve fund shortfalls.
To recap the journey we've taken today, we started with the comforting illusion of total corporate coverage. That warm, fuzzy feeling that your maintenance fees handle all the risk. We dissected a staggering $105.7 million master policy and realized it functions exactly like a giant shipping container, covering the structural steel box. but leaving you entirely responsible for your personal property down in the locker room, any upgrades beyond the builder's original bare-bones specs, and any liability for accidents that happen inside your walls.
And most critically, we uncover the mechanics of the deductible chargeback. The stark reality that a simple omission, an overflowing tub, or an aging washer hose can result in the corporation's $25,000 deductible being transferred directly to your personal ledger.
The ultimate takeaway from these documents is that you absolutely cannot rely on generic out-of-the-box renters or condo insurance. You must tailor your personal policy limits to bridge the specific deductibles and financial realities of your unique condominium corporation.
It is the only guaranteed method to protect your financial well-being in a shared, highly interconnected living environment.
But before we let you go, I want to leave you with a final lingering thought. Because there was one highly specific detail in that certificate for 7608 Young Street that we glossed over, and it has been haunting me since I read it.
Oh, I know the one you're talking about.
Yeah. Under the property deductibles, past the $25,000 for standard water and sewer claims, there is a line item for earthquake damage.
Yes. The deductible for an earthquake claim on this property is listed at a staggering $100,000.
$100,000. So here is the question you have to ask yourself. As extreme weather events become more frequent and commercial insurance companies continue raising these corporate deductibles to $50,000 or $75,000 or $100,000 just to avoid paying out claims, at what point does owning a condo stop being a turnkey, low-maintenance lifestyle and start becoming a high-stakes game of self-insuring a commercial skyscraper with your neighbors, something to chew on the next time you hear a dripping faucet?